I'm surprised by how many CPAs don't point this out to their clients. I think sometimes it's because we have a tendency of blaming the messenger, and so they just don't want to be associated with that. I want to make sure that I let my clients know when they're paying penalties or interest, because that is an easy way to save them an extra hundreds and sometimes thousands of dollars that they didn't have to pay otherwise, right? So what is an estimated tax payment? For most people, estimated tax payments are taken out automatically through your W-2. If you don't own your own business, or if you do own your own business but you're paying yourself a wage, such as an S corporation, maybe you don't need to make quarterly estimated tax payments because you're already paying that through your payroll, okay? But for those who either have a much higher tax liability, or because then they're just not having enough withheld from their W-2, they need to make quarterly estimated tax payments really just for one reason. It's not because we want to give the IRS an interest-free loan. That's not it. It's because we want to avoid underpayment penalty and interest. So there's 4 different payments that you make, 4 different times, but they're weird. It's not what you would think. The first quarter payment is due April 15th. The second quarter is due June 15th, just 2 months later. So that one's the weirdest one. The third quarter estimated tax payment is due September 15th, so 3 months later from the second quarter. And then the fourth quarter is actually due January 15th of the following year. The reason why you want to make an estimated tax payment is to avoid the penalties and interest associated with an underpayment penalty. That's it. It isn't so that you can have a bigger refund. I am anti-big refunds. I want to make sure, personally, I make sure that I have a balance due every single year, because, let's help people understand this, a refund just means you overpaid something. Let's use a very simple example. Let's pretend that you go to the store every week to buy a gallon of milk. A gallon of milk is $4. But you, in your mind, you're like, you know what? I'm gonna give this grocery store $5 for my gallon of milk every single week. And then in January, I'm gonna ask for all that extra dollar I gave them, I'm gonna ask for it back. So I'm gonna get a $52 refund. That's what a refund is for the IRS. You wouldn't purposely overpay the grocery store just so that they could hold on to your money for you and then you could get it back next year, right? It makes so much more sense that if they gave you the option, that you would say, hey, how about I give you $350 and then I'll pay you an extra $26 in January, okay? Now the IRS, they also don't want you to say, I'll give you nothing and I'll just give you the full amount in January, whatever that is that you owe them. If you do that, in other words, if you didn't make any estimated tax payments, that's when they're gonna hit you with penalties and interest, or if you make too little. But that's what it is. That's essentially why you would make estimated tax payments. It's really the only reason is to avoid those interest and penalties. That they just have no idea how much to pay. It can be complicated because in the end, taxes are calculated on an annual basis. So let's say the first 3 quarters of the year, you made $1 million net income. I would be telling you, hey, we gotta make some big estimated tax payments, like $300,000 in estimated tax payments. But then let's say Q4, you lost $1 million. You know, in this extreme example, at the end of the year, your tax liability is gonna be 0 because you made 0 money for the whole year. But the first 3 quarters, we thought you were gonna make a lot of money. This is what makes it so hard for business owners. And so under that scenario, they would be getting like a $300,000 refund, right? Ridiculous, we don't want that. That would be terrible. But that's one of the things that makes quarterly estimated tax payments difficult. But that's why when I work with business owners, we're gonna look at trends. I'm gonna say, hey, how much did you make last fourth quarter? And is this year different from last year? Do you think it's gonna be better? Do you think it's gonna be worse? Do we have any idea? So we're gonna take historical data, we're gonna take into consideration what's going on this year to come up with the best estimate, again, so that our client doesn't overpay, but also doesn't underpay, so that we can avoid those penalties. There's 3 safe harbor rules, and there's only one that's easy to guess. So the safe harbor rule is you pay at least 90% of your current year tax liability if your AGI is low enough, you'll qualify for that safe harbor rule. The easiest one to calculate is by paying 110% of whatever your total last year's total federal income taxes were. So if your total tax was $100,000, that was your total federal income tax, and you had no idea how much income you were going to have this year, but you knew it was going to be a lot more. Maybe your tax liability was going to be $200,000. You still only have to pay $110,000 in estimated tax payments to avoid the penalties for that year. So then, you would make $27,500 estimated tax payments for 4 quarters. You would still owe $90,000, which would be due by April 15th. Even if you extend, that $90,000 would be due April 15th of the following year. But so would your first quarter of that current year. So as long as you're actually budgeting the money, then that's fine to purposefully make lower estimated tax payments than 100% of what your current year tax liability is. Again, to stay on top of that, you gotta pay 110% of last year's tax liability, and so that first quarter tax payment might be pretty hefty if that's the goal that you're going for. So that's why there's kind of 2 things to keep in mind. Number 1 is not just being aware of what your tax liability is and paying it to avoid the penalties, making sure that you have the cash flow and it's not taking you by surprise. The failure to file penalty is going to be avoided by filing an extension, and that is the biggest one. So file your extension, but you're not avoiding all penalties by doing that. The underpayment penalty or the failure to pay penalty is still going to apply if you had a balance due and you didn't pay that by April 15th. So an extension is not an extension to pay. By filing an extension, if you still have a balance due, there's going to be interest and penalties. Now, it's the smaller of the 2. Failure to file penalty is a lot worse. So file an extension. There's nothing wrong with filing an extension. But if you know that you're going to have a balance due, the best thing to do is to overpay it. Again, I know I've said not to overpay it, but we're going to overpay it on purpose by the amount that you want your first quarter estimated tax payment to be as well. So let's say we have a rough idea that your 2025 tax liability is going to be another $25,000, that you owe $25,000. And we also want your Q1 estimated tax payment for 2026 to be $30,000. I'm going to tell my client not to make a Q1 tax payment, but to make an estimated tax payment for 2025 of $55,000, with the intention that we're going to have your refund applied to the first quarter of 2026. And that way, if it's a little off, that's a lot less of a penalty than underpaying the 2025 tax liability. Look at your tax return. Figure out how much federal income tax did you actually pay? What was your total tax liability in 2025, which is going to be on line 24 of your 1040. And then you're going to say, am I on track to pay at least 110% of that for 2026? And if you are, or if you aren't, it's going to be based on what my recommendation would be, assuming you're planning on making more money than you did. A lot of clients get super busy and it escapes their mind. At a minimum, I'm going to be reaching out to them in August, September, and then if I still haven't heard from them, I'm going to be reaching out to them monthly, October, November, December, because that's where, even if they missed Q1 through Q3, making that 4th quarter payment, by my calculations, when I've run the numbers, makes the most material difference to what their penalties and interest are going to be. So I want to make sure, so I'm reaching out to them by that point for sure. What triggers a recalculation? I mean, like I said in a previous example, because your taxes are calculated on what happened after the whole year, it's whenever that is materially off. When I'm making estimated tax payments, or when I'm helping my clients calculate their estimated tax payments, I'm basically saying, okay, how much did you make in Q1? and how much do you think you're gonna make in Q2, Q3, and Q4? And then after Q2, I'm gonna say, okay, how much have you made year to date, Q1 and Q2, and how much do you think you're gonna make in Q3 and Q4? And so on and so forth, right? Well, what would cause a recalculation is if what we guessed in Q3 and Q4 turns out to be way off, and you know that earlier on. So like if July happens and all of a sudden the whole world shuts down because there's a second COVID, and you know that you're going to be affected either because you're going to make a lot more money or a lot less money, that's going to change, right? And so we want to recalculate it before you make your next payments, your Q3.